Hey everyone, welcome to this explainer on the 5 pillars of financial survival. If you've ever felt completely overwhelmed by the absolute avalanche of financial advice out there, trust me, you are not alone. Digging into the research for this, I stumbled upon a truly liberating truth. Building lasting wealth? It actually isn't about being some genius stock picker, and it's definitely not about constantly chasing the highest possible returns. Nope, it's really about mastering the mathematical realities of time and, above all else, sheer survival. So today, we're going to break down the iron laws of wealth logic. We'll look at exactly how momentum builds growth, how structure captures it, and how asymmetry makes sure you're actually still standing at the end to collect it. Let's get right into it.
All right, kicking things off with Section 1, time beats the amount saved, or breaking our linear intuition.
Okay, let's dive into this. You see, as humans, we are basically hardwired to think in straight lines. We just naturally assume that if you put in twice the time, you'll get twice the money, right? But here's the thing, compounding works in curves. It's a totally different beast. Take a look at this comparison. We've got the early saver. Now this person contributes for just 10 years, investing a total of 60 grand, and then they completely stop. They don't add a single dollar for the rest of their entire career. Then we have the late saver. They start exactly 10 years after the first person, but they contribute for 30 years. That is 3 times the time and 3 times the capital, a total of $180,000 invested.
So 40 years later, who actually wins? I gotta tell you, it completely blew my mind to realize that despite trying so much harder, putting in 3 times the effort and 3 times the cash, the late saver finishes over $250,000 behind the early saver. Literally over 250 grand behind. And they were in the exact same market, getting the exact same return. The early saver won simply because time compounds infinitely harder than money ever could.
You can really see why this happens when you look at the rule of 72. If you just divide the number 72 by your expected annual return, it estimates exactly how many years it takes for your investment to double. So let's say you're getting an 8% return. That means your money doubles roughly every 9 years. Now, stretch that over a 40-year career, and a single dollar is doubling more than 4 times. So starting just 10 years late, it doesn't just erase your first 10 years of savings. No, it permanently erases your final doubling period at the very end of your timeline, and that is the one built on your largest accumulated balance. That's a massive hit.
This perfectly captures what we call the ski jump effect of compounding. Look at the incredibly flat slope of those first 10 years. If you're saving, say, $500 a month at an 8% return, it yields about $91,000. Honestly, it feels like pushing a massive boulder that is just barely moving. But then look at the final 10 years of a 40-year timeline. The balance just explodes, growing by over $1 million. That's more than 10 times the growth of the entire first decade. At that point, momentum just totally takes over, and the boulder is basically rolling downhill all on its own.
Moving right along to Section 2, income versus equity ownership, or the river and the reservoir. So to really feed that compounding momentum we just talked about, we have to know exactly what kind of money we are dealing with. There are 2 kinds, and man, confusing them is a remarkably expensive mistake. First up, we have the river. This is your salary. It's the income that pays the bills and keeps you alive month to month. But the thing is, it does not compound because, well, you consume it. The moment you stop working, the river runs completely dry. On the flip side, we have the reservoir. This is equity ownership. We're talking shares of a business, property, assets you just hold and do not spend. The reservoir actively compounds and actually pays you while you sleep. Basically, income keeps you alive, but equity sets you free.
And what this ultimately means is that a raise is not the same thing as getting wealthier. I know, it sounds counterintuitive, but think about a high earner making $200,000 a year who spends absolutely every penny of it just to maintain a lavish lifestyle. How long can they actually survive if they stop working tomorrow? 0 days. They're totally bankrupt the very second that paycheck stops. Now picture someone earning maybe $80,000 a year, but who has quietly built up a $1 million equity reservoir. By drawing a safe, say 4% a year, that lower earner can survive indefinitely. So wealth isn't about the size of your river, it's entirely about the depth of your reservoir.
All right, Section 3, the reality of leverage, or borrowed amplification.
Now, leverage is incredibly popular in the financial world. It's often dangerously sold as this sort of risk-free magic trick to build wealth super fast. But the unvarnished truth, leverage is simply a lever that does not know which way you want it to push. It is absolutely not free money, it's just borrowed amplification. So yes, it aggressively multiplies your gains. But, and this is a huge but, In exactly the same mathematical proportion, it mercilessly multiplies your losses.
And this brilliantly illustrates exactly how fast things can go completely wrong, just using a standard real estate scenario. Say you buy a $300,000 house with a 10% down payment. That's $30,000 out of pocket. If the house goes up 10%, boom, you just doubled your money, 100% return on your cash. Awesome, right? But run it the exact opposite way. If the house drops just 10%, your loan doesn't shrink. You still owe the bank the full borrowed amount. So that minor 10% dip, it completely wipes out 100% of your equity. You're left totally underwater, owing more than the asset is even worth.
Which brings us to Section 4, the fatal number 0 and the math of recovery.
This is where we get into asymmetry. You see, the single most important strategy in all of investing isn't about picking winners. It is sheer, uninterrupted survival. And the brutal, curved math of recovery shows exactly why. People mistakenly think a loss and a gain are equal opposites. Actually, scratch that, they definitely aren't. If you lose 10%, you need an 11% gain just to recover. Not too bad. But if you lose 50% of your money, you don't just need 50% to recover. You need a 100% gain just to get back to where you started. Lose 80%, you need a 400% gain. Lose 90%, you need 900%. As you take deeper losses, you require exponentially larger returns just to tread water. And if you follow that curve to its terrifying conclusion, you hit 0. Compounding really only has one fatal enemy, and it is the number 0. If you bet too big, use way too much leverage, and hit a 100% loss, absolutely no future return can ever bring your money back. Like literally infinity wouldn't do it. An entire lifetime of disciplined saving and compounding completely collapses to nothing if you touch 0 even once. You absolutely must protect the downside at all costs.
Now for our final part, Section 5, Hedging Against Your Ignorance and the Reality of Stock Picking.
We hear all the time that the ultra-wealthy concentrate their bets, right? So why shouldn't the rest of us do the exact same thing? Well, looking into the sources, the statistical reality of the stock market is honestly shocking. If you pick a single stock at random, 2 out of 3 times it will end up worth less than where it started. Yeah, 2 out of 3. It's actually a tiny 4% sliver of absolute monster companies that produces the vast majority of all market gains. The other 96%, they're just average or outright losers. The index doesn't go up because every stock goes up. It goes up because those 4% drag the entire market's average upward.
So, unless you actually own the business or have total control and true deep inside understanding, picking single stocks is honestly just gambling with extra steps. As this quote perfectly captures, diversification is not weakness. It is a hedge against your own ignorance. By owning the whole index, you aren't being timid. You're actually making a mathematically sophisticated move to quietly guarantee that you capture that 4% of massive winners, all without letting a single failure wipe you out. Let's bring this all together. 5 questions before you invest. The pillars of survival.
So, the crucial point is, we've talked about momentum, structure, and asymmetry. Now let's synthesize all this source material into a highly practical checklist. Before putting a single dollar on the line, you need to run it through these 5 questions as an absolute prerequisite. First, can this compound? Like, are you giving it enough years to hit that explosive ski jump curve? Second, who controls it? Are you driving, or is someone else? Third, what happens if it fails? Do you get something back, or absolutely nothing? Fourth, can any single loss take you out? Remember that fatal number 0. Never bet so big that one bad break ends the whole game. And fifth, maybe the most important, do you actually understand it? Because if you can't explain exactly how it makes money and what could go wrong, it's not an investment, it's just a hope.
We've covered a ton of ground today, looking closely at how time beats money, how leverage cuts both ways, and how surviving the math of recovery is far and away your greatest advantage. I want to leave you with this final, provocative thought to carry with you. Take a hard look at where your energy goes every single day and ask yourself, are you just building a bigger river, or are you finally filling a reservoir? Remember, financial survival is not the boring part of investing, it is the entire strategy. Thanks for joining me on this explainer. Keep learning, stay focused, and I'll catch you next time.